Today I'd like to talk to you about three undervalued, low-cost businesses that are irresistible in the marketplace because they're gaining share and killing competitors, but also I hope to show you that they're irresistible from an investment point of view in that the share prices are dramatically undervalued. The first of those three companies is JD Wetherspoon, which of course I spoke about at this conference last year. It's still cheap, I think, and indeed I've put in the appendix some of the metrics that you might be interested in just to show that I think it is still cheap. But I'm also going to use my interest in Wetherspoon as a bit of a template for a couple of new ideas. This goes back to last summer when I was thinking to myself how much I really love the way that Wetherspoons operates and how much I love it as an investment. I've been a shareholder for about 5 years. And I thought to myself, maybe it can be a template for a couple of new ideas. I would love to own more businesses that look like Wetherspoon. In particular, I love it for 6 reasons. First of all, I think the share price is undervalued. That, of course, is absolutely imperative. But from a business perspective, it operates a high-volume, low-cost, low-price business model, which is very disruptive. It's a pub operator. It has very different pubs from all of its competitors. The 2 photographs that you can see there are one of its newest pubs. This used to be something called the Royal Pavilion in Ramsgate, a seaside town about 50 miles southeast of London, which Wetherspoon renovated, finishing last summer. This pub has 10,000 square feet of space to serve customers. It may be the largest pub in the UK, as far as we can tell. So as a low-cost, disruptive business model, reinvesting virtually all of its retained profits to drive further scale, to drive costs down, in order to justify lower prices to boost demand. As a result of that, this business model is difficult and expensive for any competitors to replicate. As I said, it's taking share and killing badly run competitors. The number of pubs in the UK has been declining by about 2% for as long as anybody can remember, certainly over the 35 years that Wetherspoon has been operating. It has high returns on capital, it has pricing power, and it's still run by the founder today, who owns 30% of the stock. I think it goes without saying he's a great operator. He created this business out of thin air in an industry where there are no natural advantages. In addition, he's a great capital allocator. They have bought back, over the last 14 years, over half the stock, only buying back when the shares are cheap. So, wouldn't I love to own a couple more businesses that look like that? And these are the 2 that I want to talk to you about. First of all, there's Ryanair, which is now Europe's largest airline, with about a 15% market share. This too is a business that has been created out of nothing in the last 20 years by the founder and chief executive Michael O'Leary. Just some simple metrics. The market cap today at about 16 euros a share is 19 billion. There's a small amount of debt. The second company is Sports Direct, the UK's largest sporting goods retailer. This company was founded in 1982, but in 35 years it has become the 45% market share leader. Once again, pretty strong testament to the fact that the founder is a very, very good operator. It has 468 UK stores, nearly 300 across 20 other countries. 20% of the business is online, and at the current share price of about £3.65, the market cap is 2 billion. There's 500 million of debt. So, for the rest of this presentation, I would like to take you through those 6 characteristics that I love so much about JD Wetherspoon and explain to you why I think both these 2 companies stack up quite well on those same 6 metrics. First of all, undervalued. So Ryanair today, you're paying about 14 times earnings. Against that, you've got to factor in all of the advantages that I was talking about before, the fact that it's a cost leader, the fact that it has very high returns on capital. Last year, 30% return on equity. It's probably got 8% future volume growth ahead of it. It's got pricing power. It's got a great operator running the business and a great capital allocator. And I just think that's way too cheap for a company of that quality and that potential. Why? Well, it is an airline. Value investors tend to steer clear of airlines. It is cyclical, it is capital intensive, and of course there are some worries about what might happen to aviation between the UK and the rest of Europe following Brexit. But like I say, I think that's way too cheap for a company with those types of metrics. Sports Direct is even cheaper. I think today you're paying 7 times earnings, provided you're willing to make the following assumption. And one of the reasons that that the share price is down, as you can see, the all-time high was £9.22. I'm saying here the current share price is 381. On the previous slide it was 365. Apologies for that. That's a bit of version control, but it's a long way south of the all-time high. And one of the reasons for that is that the share price fell very sharply after the Brexit vote on the 23rd of June 2016. The reason was, unlike all of its competitors, Sports Direct was not currency hedged. It buys most of its product for sale in its stores in the Far East, priced in dollars. When the pound fell, its cost of goods rose. Its competitors who were hedged chose not to change prices. Why would they? So Sports Direct did exactly the same thing to maintain market share, and as a result, margins went from about 10% to about 4%. You only have to believe that either the pound regains its position against the dollar, or when the competitors' hedges roll off, they will raise prices if the pound has not recovered. You only have to believe that margin structure, which was prevalent in the industry before the Brexit vote, returns to its previous levels, and then you're paying 7 times earnings for Sports Direct. Why is that? Why is it so cheap? Well, perhaps people are worried about Amazon. We'll talk about that in a minute. The founder is a bit eccentric, not to everybody's taste, I think. Whatever the reason, it seems to me that's a pretty ridiculous price. So now we'll talk about cost leadership. Here are some metrics for Ryanair. In the top left here, you can see costs versus competitors. This was on a per passenger basis. Ryanair is streets ahead of the 5 airlines that are highlighted, which are Wizz Air, EasyJet, Norwegian, and Air Berlin. The numbers here are pretty extraordinary, at least 30% cheaper than the next cheapest competitor. On a similar basis, here are some average fares, very, very low prices against average fares against the competition. Looking at the low-cost business model from a Sports Direct perspective, thanks to Gary Shannon of Phoenix Asset Management for this material. This is a basket of goods at Sports Direct versus Amazon, and a basket of goods versus Sports Direct's largest traditional competitor, which is JD Sports. As you can see, it's cheaper than Amazon, and it's a lot cheaper than JD Sports. I mentioned I like the fact that Wetherspoon has this disruptive business model, an aggressive business model, reinvesting to drive further scale and lower costs. Well, who can doubt that Michael O'Leary is disruptive, aggressive, and reinvesting? This is the Sports Direct founder and chairman, Mike Ashley. Both companies, I think, believe that if your prices are low enough, customer service doesn't matter so much. Both companies have acquired bankrupt competitors and or their assets, or they have bought assets out of bankruptcy. Neither of the companies pay a dividend, as I said, reinvesting every penny of retained earnings to drive further scale and further cost reduction. Mike Ashley is famous for saying, where else are they going to go? If my prices are low enough, where else are they going to go? I also mentioned one of the things that I love about Wetherspoon is that the business model is difficult and expensive for any competitors to replicate. One of the things that I think is really important here is that both Ryanair and Sports Direct have established their position at a time when their industry, when their marketplace was much more fragmented. So they have grown scale, they have grown their networks, they've grown a reputation for low prices. They own important assets. Ryanair owns 430 aircraft, basically debt-free. Actually, this is pretty amazing in itself. They own 430 aircraft, basically debt-free, and yet the return on equity last year is 32%. Pretty extraordinary numbers, I think. In the case of Sports Direct, it owns a number of very important low-cost, low-end, low-price brands, which gives it the opportunity to have a wide range of price points within its stores. It's kind of hard to imagine that any incumbent which has the scale would rejig their business model sufficiently to be able to compete at the level of prices that Ryanair and Sports Direct have. And of course, if you're a new entrant, then you just don't have the scale to justify the prices. Taking share and killing competitors. Now, many of the people in this room are probably too young to remember, but at the time when Ryanair started 20 years ago, the number one competitor in all of these countries probably would have been the national flag carrier, British Airways in the case of the UK. It's pretty extraordinary to think what has happened in the course of the last 20 years, and now Ryanair is number one or number two in all of these markets, and number one overall in Europe, in the space of just 20 years. Sports Direct is also taking share and killing competitors. Probably the most famous example of that was when it virtually forced JJB Sports, the number 3 competitor in the UK, into bankruptcy in 2012. JJB had some financial problems, and Sports Direct took the opportunity to take down prices, cutting their margins in this period here. You can see the gross margins having come down and the net margins having come down rather more, culminating in JJB Sports filing for bankruptcy in 2012. High returns on capital. Top left, we've got Sports Direct, something like 25% average. Don't be misled by this fall here. This is as a result of the higher cost of goods caused by the fall in sterling. If you take that out, 25% returns on equity, returns on capital. Ryanair, of course, being an airline, is more cyclical, but through the cycle, these are very, very attractive returns on capital, returns on equity. Pricing power. One of the things that I think is very attractive about Ryanair is that they have used pricing very strategically, very tactically, so that you can see in the few years after the financial crisis and up to 2015, 2016, average fares were in fact rising, but following some bankruptcies and some opportunities to gain share, they've taken prices down, way back down towards the 40 euro level in order to gain business. And I found this nice quote, for now we see significant opportunities to expand and wish to do so ahead of others that might see that opportunity too. However, we have always believed that one day there will be 5 airlines in Europe, 3 long-haul carriers and 2 low-cost carriers. We're getting closer to that point. When we get to that point, prices will be higher. In the case of Sports Direct, I think it's a slightly more complicated story, but I think they have pricing power in part because they have this large cost advantage versus the competition. I think they have pricing power in part because either through the rolling off of hedges of their competitors or the pound recovering its level versus the US dollar. That also, I think, gives them the potential to raise prices. But also what has been happening with some of their largest suppliers. So traditionally, Sports Direct used to offer high-end Nike and Adidas goods in its stores at a 30% discount. Of course, the brands hated that and tried to put pressure on Sports Direct to discontinue that practice, eventually refusing to supply them. And Sports Direct resisted for many years, but ultimately they said, okay, you win. So now if you go back into many Sports Direct stores, you'll see the top-end Nike and Adidas trainers on sale, but they're now at full price. And of course, all that this has done is that it's created a bit of a price umbrella under which Sports Direct can price its second-tier and low-price brands, but at a somewhat higher level than they used to in the past. So for all three of those reasons, I believe that Sports Direct also has pricing power. Finally, owner-managers, indeed founder-managers, who are great operators and capital allocators. I think I would argue very passionately that all three of these companies have basically created themselves out of thin air in the last 20 years in the case of Ryanair, 35 years in the case of Sports Direct, and have taken share and killed competitors. So it almost goes without saying that they're great operators. But they're also great capital allocators. This is a chart of the buybacks and the occasional special dividend that Ryanair have done over the last 10 years or so. And you'll notice the quote from Michael O'Leary: "We bought back 22% of the equity over the last 8 years. The board reviews on an annual basis what the surplus cash will be and whether we do special dividends or buybacks. We're tending towards a policy of buying back where the price-earnings ratio is below 15 and doing special dividends when the price-earnings multiple is above 15. That's a very nice discipline as a potential shareholder. If you look at Sports Direct, Mike Ashley bought back 10% of the shares following the fall in the share price after the Brexit referendum, obviously at a very attractive price. And I should say that both Sports Direct and Ryanair recently announced extensions to their buyback programs in February. So just before I finish, I wanted to say thank you to a number of investors who alerted me one way or another to these ideas. Andrew Hollingworth on both ideas, in fact. Thank you to Andrew. Simon Dennison-Smith of Metropolis Capital for Ryanair. Gary Channon, of course, spoke about Sports Direct at this very conference 2 years ago, but you can buy the shares today at pretty much the same price that Gary Channon was pitching them 2 years ago. And also OD Asset Management have spoken to me a little bit about Sports Direct too. So in summary, irresistible. 13 or 14 times earnings for Ryanair, 30% cost advantage versus number two, a disruptive business model, reinvesting for more scale, lower costs and lower prices, pretty difficult for any competitor to replicate, taking share, killing competitors, high returns on capital, pricing power, and great operators and capital allocators. That's it. Thanks very much. I'll now take some questions.
Thank you. Thank you very much, Simon. Any question?
Hi. Thanks for your presentation. On Sports Direct, and namely you mentioned large cost advantages. So I was just wondering if you could explore a little bit where in the cost structure do you see those advantages, and against whom? I'm guessing JD Sports, but maybe others. And then what's your take on those recent news on the working conditions of staff in the warehouses? And do you think that those cost advantages may come from that, in part? And how will they be affected? Thank you.
Okay. So I think the principal source of cost advantage in Sports Direct is, well, there are two. One is scale, and the second is that they're selling lower-priced product. So if you go into a JD Sports, you will find a much bigger proportion of the product range is going to be your top-of-the-line Nike and Adidas, and they don't really have the equivalents of the Slazengers, the Carrymores, the Everlasts, the second-tier brands. So I think those two factors are really important. I also think that Mike Ashley is a terrific retailer. I think they have a large group of very quantitative analysts running a whole lot of marketing and pricing related experiments, which gives them a big advantage. In terms of the working conditions, yeah, and this may be one of the reasons why the share price is why it's such an unpopular stock. Mike Ashley is a bit of an eccentric character, and definitely not to everybody's taste, but I think they'll fix those problems.
Aren't there huge governance issues as well in Sports Direct? Corporate governance?
You have something particular in mind?
Incestuous members of the board.
Well, I think, once again, I think these are massively overdone. I mean, Mike Ashley owns 60% of the stock of Sports Direct, and basically since day one he has paid himself a salary of exactly zero. He's had a bonus of exactly zero. Yes, there have been questions about payments to members of the family, but those have always been resolved with Mike Ashley completely recusing himself from the decision-making process. So there's no doubt he's a bit eccentric. There's no doubt that there are some policies there that you love, and there's the occasional policy there which you may not like so much, but overall I think the concerns are massively overdone. There's one at the back with the mic, and then over here.
Thank you, it's very interesting. Basically my question is concerning Ryanair, and you assume 8% volume growth. I was wondering how you derive that, because at the end of the day you have Air Asia in Asia, and it's Air Asia, a company like in Malaysia, and it's growing in those lines as well. And you have two trends there that you don't have them in Europe by any standard. You have like an emerging middle class who is flying for the first time in some cases. Yeah. And secondly, the market there is like regulated, and like it's coming to liberalization. Whereas in Europe you have like liberalized market, so there is no tailwind from there.
Yeah. So the 8% number is a management number, but it's basically consistent with their order book of aircraft. So if they take the aircraft that they've ordered according to the schedule that they have ordered them, and then they proceed to fill them to the normal load factor, then there will be 8% passenger growth. How does that happen? Well, I think it happens basically by killing competitors. You're right, you haven't quite got the tailwinds of massive growth. You've still got reasonable growth in leisure travel in Europe, but most of it, I think, comes from killing competitors. And I was taught business strategy at London Business School by a guy called Gary Hamill, Professor Gary Hamill. Some of you may know him. And on the very last day of the entire two-year course, he said to us, the next time I see you, my students, I want to know how many competitors you've killed. And it always struck me that the very essence of business strategy was about taking market share, ultimately killing competitors. And if you had to pick an industry where you thought the competition would be most susceptible to being killed, you might pick airlines. But specifically, of course, the national flag carriers all across Europe are generally run extremely badly. Very high cost, very high price, and therefore the opportunities for the low-cost airlines, and specifically Ryanair, I think are there to fulfill that 8% growth.
Thanks for the presentation. Another question about Sports Direct. Don't you think they're taking on a bit too much at the moment? Repositioning their UK stores more in line with JD Sports. There's some restructuring going on in continental Europe. They're expanding into the US. They're buying a lot of properties, moving more into fashion. There's so much going on, and all of these issues are very, very challenging in itself. And that was our concern. Otherwise, I agree with everything you said about them.
Yeah. I think I'm going to be very cheeky with that question. When I come to conferences, I would prefer to hear more ideas with basically a very simple and short thesis about why you should invest your time researching them. So I choose sometimes not to talk about one stock in detail, but to talk about several stocks more or less in outline, with the kind of, in this case, it was kind of the 6 reasons why I think you should devote some time to researching them. And as a result, I'm not going to answer all of the questions. And if it sounds a bit cheeky, and I'm sorry, but I don't have a great answer to your question. And I think that's if you like the 6 reasons why these stocks look interesting, it's up to you then to go and fill in the details and work out all the difficulties and to decide whether you're comfortable. Clearly, I'm aware of that issue, but I don't have a great answer to your question.
That's fine too. Thank you very much, Simon.
Thanks very much.